PantheonAI presents Market Surge Amid Global Chaos Globe, Iran Tensions, Bitcoin Rally, and Tariff Warnings. Welcome to the PAI Morning Briefing. I'm John from PantheonAI, and it is June 16th, 2025. Good morning, everyone.
And I'm Sarah. Hope you're all ready for a really deep dive into the markets today because, wow, we have so much to cover.
Absolutely. We're going to kick things off with a quick market overview, then jump straight into some of the major headlines that are really rattling the markets. And finally, we'll wrap up with our expert analysis and, a few thought-provoking questions for you to ponder. So grab your coffee, sit back, relax, and let's get started. All right, let's begin with a snapshot of the major indexes and cryptocurrencies this morning. The S&P 500 is trading at roughly 6,041, up about 0.62%. The Dow Jones stands around 42,597, having climbed approximately 0.7%. Meanwhile, the Nasdaq is actually leading a modest rally, standing near 19,709, with an increase of around 0.8%.
Wow, those are some solid numbers. And the Russell 2000, John? How's that looking?
Good question, Sarah. Over in the Russell 2000, we're seeing a slight increase, now positioned at roughly 2,124, up around 0.45%. And in the crypto space, Bitcoin is trading at approximately 107,704, gaining about 2%, while Ethereum is at roughly 2,645, up nearly 3.84%.
It's really interesting to see these numbers this morning, especially that steady momentum across both traditional stocks and, the crypto markets. It kind of feels like the market's slowly waking up, stretching, and preparing for a busy day ahead. But, these numbers, while promising, are definitely only part of the story, aren't they?
You're absolutely right, Sarah, they are. And that brings us to a deeper dive into some of the major market trends. One of the critical themes, still very much alive in the market, is the persistent tension across global geopolitics, particularly in the Middle East.
Yeah, we're seeing headlines suggesting Iran is preparing for what officials are calling the largest and most intense missile attack in history on Israeli soil. This news, coming right after Israel bombed an Iranian television station, it's just set off alarm bells for investors. Any escalation there typically has a pretty pronounced impact on global energy prices and, of course, overall risk sentiment.
And in conjunction with that geopolitical backdrop, our markets are also digesting some mixed signals from key economic sectors. For instance, oil prices were actually showing signs of moderation today, as highlighted in the 10 Things to Watch in the Stock Market Monday report. Despite the tension in the Middle East, rising oil prices appear to have slowed a bit, which, could provide some temporary relief to consumers and businesses.
Yeah, but the longer-term picture there, John, still feels pretty uncertain, right? As we all know, the energy mix in our portfolios can be as unpredictable as your favorite weather forecast. 1 minute it's sunny, and the next, you're caught without an umbrella.
That's a great analogy. And adding fuel to the fire, Deutsche Bank has flagged concerns over a looming tariff deadline coupled with those persistent inflationary pressures.
Their warning really serves as a reminder that even when geopolitical tensions seem to occupy most of our headlines, underlying economic issues like inflation and trade policies continue to exert a strong influence on investor sentiment. In some ways, it's like that friend who always reminds you about your budget even when you're having a great night out. Sometimes the warnings are just too hard to ignore.
That's so true. And interestingly, in our Why Markets Are Ignoring Scary Headlines About Iran, Trade Wars, and U.S. Debt piece, strategist Tom Essaye provided some valuable insight into why investors may appear indifferent to a barrage of concerning news.
Yeah, Essaye argues that while these issues undoubtedly pose risks, the market has become incredibly adept at compartmentalizing risk. In other words, it remains resilient in the face of multiple headwinds. Investors, after all, are seasoned by years of seeing headlines come and go, and they're perhaps looking at these signals not as existential threats, but just as manageable parts of their broader risk management strategies.
Which is a really smart way to look at it. Now, transitioning from these big macro themes into individual company news and transactional updates, we've got several important stories that definitely deserve our attention, each of which might just add another twist to today's market narrative.
All right, so first up, that headline grabbing our collective attention. It's that report that Iran is preparing for what's being described as the largest missile attack on Israeli soil. With tensions absolutely skyrocketing in the region, this development sends shockwaves through the energy market, particularly as oil continues to be one of the world's most vital commodities.
Investors are naturally concerned about the potential ramifications on supply chains and global oil trade routes. And while the immediate effect might translate into short-term volatility, the long-term implications, they really remain to be seen. It's interesting. Sometimes the news just feels like a suspense thriller, where every headline leaves us wondering what happens next.
It really does. In another significant update, Baker Hughes has announced it's acquiring Continental Disk, a pressure management firm, for a deal valued at $540 million.
That's a big move. This not only consolidates Baker Hughes' position within the energy pipeline support sector, but also really underscores the continued strategic investment in infrastructure. The acquisition may also hint at tighter capital allocation and increased focus on technology integration in the pressure management space, a positive sign for those who are bullish on the energy sector and the innovative ways it adapts to changing market dynamics.
Absolutely. And shifting gears to the retail space, Cantaloupe has agreed to be acquired by 365 Retail Markets at an agreed share price of $11.20. This transaction, John, is yet another example of the ongoing trend where consolidation in the retail industry is gaining momentum.
Right. With market dynamics constantly evolving, mergers and acquisitions in this sector can often create interesting arbitrage opportunities for investors, especially those with an eye for companies that have strong fundamentals and a promise of scalability post-acquisition.
And speaking of energy, MEG Energy's board recently made headlines by rejecting a takeover offer from Strathcona valued at $4.2 billion. That's a huge number.
It really is. The decision by the board highlights both their confidence in MEG's long-term strategy and the complex dynamics that underpin large-scale acquisition proposals in the commodity sector. Decisions like these often leave investors wondering about the potential upside of maintaining an independent trajectory versus the short-term gains from a merger or acquisition.
Yeah, it's a constant balancing act. Now, turning to the financial sector, U.S. Steel has made waves with its stock surging following developments involving a so-called partnership with Nippon that appears to be coming to an end after roughly a year and a half. This move, hinted to be a response to certain political pressures, even a nod to actions championed by the former president, has generated considerable discussion about the golden share concept. Market watchers are curious. Will this be an isolated incident, or does it signal a broader trend of political influences reshaping public company strategies, particularly in heavy industry?
That's a fascinating question. And also in finance, Deutsche Bank's cautionary note about the looming tariff deadline, combined with inflationary concerns, has added another layer of complexity to investor considerations. Their warning, coming at a time when market confidence is already being tested by external pressures, really underscores the restrictive environment that global trade and monetary policies are creating.
For those of us navigating these murky waters, it's important to remain cautious, while also remembering that markets often find ways to adapt and innovate, even in the toughest of conditions. It's not always doom and gloom.
Exactly. And in another fascinating development, proxy advisory firms, including ISS and Glass Lewis, have thrown their weight behind Sunoco's offer for Parkland. This alignment of influential voices within the corporate governance space signals confidence in the strategic direction of the deal.
It's a huge reminder of how intertwined corporate governance and investor sentiment are, and how a single nod from a respected advisory group can spark significant movement in market activity. It really can change things.
And we also have news about Mineros SA, which is now in the spotlight as it has become the target of a public share offer by Sun Valley.
This move is stirring up excitement among those who track smaller capitalization firms and niche markets. As such, offers often open up opportunities for strategic repositioning within the sector. It's a busy day for M&A, it seems.
It really is, and tying all these themes together, our news roundup has continued to evolve, with each story providing a piece of the larger economic puzzle. And if you're like me, you might be asking, how do all these varied developments, from geopolitical tensions in the Middle East to merger announcements in retail and energy, and even the curious case of U.S. Steel's market maneuvers, how do they affect you as an investor, Sarah?
Oh, that's the big question, John. And that's something we'll unravel as we proceed to our detailed sector analysis. So let's now take a few minutes to discuss the sector-specific implications of these stories, starting with technology, then energy, and finally finance.
In the tech sector, the narrative isn't solely about the usual big players. While headlines talked about Alphabet in relation to general market watchers, it's worth noting that tech companies continue to be at the forefront of major market movements. Whether it's through innovations in artificial intelligence or ongoing adjustments to regulatory pressures, tech companies are setting the pace for global change.
Absolutely. For example, even as market futures fluctuate, investors should understand that companies in the tech sector are often agile and capable of pivoting quickly in response to market dynamics. The challenge for tech investors remains balancing high growth potential with the inherent volatility that comes with rapid innovation. And let's face it, navigating tech investments can sometimes feel like trying to solve a challenging puzzle, with half the pieces possibly coming from a different box.
That's a perfect description. Now, when we turn to energy, the repercussions of geopolitical events are immediately evident. The tension in the Middle East, coupled with changing dynamics in oil supply and demand, has been a recurring theme pushing energy prices higher.
And Baker Hughes' acquisition move, as we mentioned earlier, is more than just a corporate transaction. It's a sign that companies are preparing for a future where energy management and infrastructure resilience become even more critical. As energy investors weigh their exposure, it's important to consider not only the traditional oil and gas segments, but also the growing emphasis on technological innovation in energy distribution and management. And, a humorous side note, in energy circles, you might even hear traders quip that while oil prices might sometimes feel like a roller coaster, at least it's never boring.
Haha, that's true. Amid all the volatility, it's these unpredictable twists that advance discussions on risk management and future energy infrastructure investments. Now, on to finance. A shadow realm where political pressures, tariff deadlines, inflation, and corporate governance merges can have a dramatic effect on stock valuations. U.S. Steel, with its intriguing market developments and political illusions, stands out as a particularly captivating case.
Yeah, their stock movement is reflective of both industry-specific challenges and the broader geopolitical interplay. And Deutsche Bank's warnings about the looming tariff deadline serve as a stark reminder for all investors to hedge carefully and monitor macroeconomic trends closely. For those who hold a diversified portfolio, the finance sector's performance can often be a bellwether for overall market sentiment. And while it might not always come with flashy headlines, understanding the subtleties of these dynamics is crucial for making informed decisions. I like to think of the financial sector as the saga of a long-running drama series. Each episode builds on the previous one, and while not every twist is surprising, the cumulative storyline is simply too important to ignore.
That's a great way to put it, Sarah. When we step back and consider the global market implications of these developments, a few key themes really emerge. The geopolitical tensions in regions such as the Middle East have immediate impacts on energy prices, but they also pose long-term questions about global trade stability and investor risk appetite. Could the dramatic rhetoric over missile attacks or geopolitical maneuvers lead to shifts in alliances or new trade agreements?
And what about the more domestic concerns, like tariff deadlines and inflation? When combined with external shocks, they might force central banks into recalibrating monetary policies sooner than anticipated. For investors, one of the critical questions remains how to balance the risk of immediate geopolitical fallout with the longer-term prospects of continued economic growth and innovation. It's a bit like trying to decide whether to carry an umbrella on a day that looks partly cloudy. Sometimes the forecast is clear, but the nature of unpredictability means you always need to be prepared for sudden changes.
That's so true. Over the past few years, we've seen governments and corporations alike adjust their strategies in light of these complexities. Mergers, acquisitions, strategic divestitures, and changes in corporate governance aren't isolated events. They're, in many ways, a response to this new world order where economics, politics, and technology increasingly converge. The market's resilience, despite myriad challenges, suggests that investors have become adept at diversifying their strategies and hedging against various forms of risk. However, this also calls for constant vigilance and an agile mindset when making investment decisions. Every move in the market is part of a broader narrative that can often be interpreted in multiple ways, leaving us with interesting puzzles to solve every single morning. To add a personal note here, as much as I appreciate discussing these technical details, sometimes I can't help but chuckle. Investing can feel like you're simultaneously trying to do a Sudoku puzzle while riding a unicycle on a tightrope.
Oh, absolutely.
But hey, if life were predictable, where would the fun and the profit be? That's why keeping a sense of humor and a clear head is essential. I always remind myself that if you're ever in doubt about an investment, it might be helpful to step back and ask whether you're trying to solve a math problem or simply enjoying a roller coaster ride. And speaking of rides, don't forget to secure your seatbelt. These market trends can take you on quite a journey.
Haha, good advice. Let's now wrap things up with some expert insights and predictions. Many of our leading market strategists suggest that while we might see near-term volatility as these geopolitical and economic concerns continue to simmer, the longer-term outlook remains cautiously optimistic. On the energy front, for instance, analysts anticipate that the current uptick in oil prices is unlikely to be sustained indefinitely, especially if there is a temporary easing in tensions. However, should those challenges escalate, we may very well be looking at a prolonged period of higher energy costs, which would not only affect corporate margins, but also consumer spending around the world.
And in technology, the narrative continues to be one of both exponential growth and careful calibration. As companies invest heavily in artificial intelligence and innovation, there is a corresponding need to manage the risks that come with rapid development and regulatory oversight. The tech sector remains one of the key drivers of market performance, but it is no longer immune to the broader economic shifts influenced by trade policies and international data regulations. If you're a tech investor, it might be worthwhile to keep close tabs on fiscal developments in major economies, because those regulations could very well determine which companies emerge as future winners.
Meanwhile, in the finance realm, the interplay between political decisions and market responses is sure to keep us busy in the coming days. For example, U.S. Steel's recent stock surge hints at a broader acceptance of corporate maneuvering in response to political pressures. At the same time, with Deutsche Bank's warnings echoing in the halls of investor meetings, there's a clear signal that the macroeconomic policies are about to become even more tightly intertwined with corporate performance metrics. The takeaway here is to always be prepared, diversify, hedge effectively, and perhaps most importantly, never let a single headline dictate your long-term strategy.
As we contemplate these developments, it's worth asking ourselves some thought-provoking questions. How much risk are you willing to assume amidst persistent geopolitical challenges? What steps can you take today to safeguard your portfolio against both market and non-market risks? And in a world where every news story seems to suggest the end is near, how do you stay true to a long-term investment thesis while remaining nimble? These are not questions with easy answers, but they are the very questions that keep the brilliant minds of our investment community engaged and innovating day after day.
Before we conclude today's briefing, let's just revisit our key takeaways. The market is currently in a state of measured optimism, with major indexes and cryptocurrencies showing modest gains while balancing a host of global and domestic challenges. Geopolitical tensions in the Middle East are weighing on energy prices and investor sentiment, while mergers and acquisitions signal that corporate players are actively rebalancing their positions. Whether it's Baker Hughes securing its place in the pressure management market, or U.S. Steel experiencing dynamic shifts influenced by political currents, the overarching theme is one of cautious adaptability.
Exactly. In the technology space, we see continued growth tempered by regulatory concerns and rapid innovation cycles. The finance and energy sectors remain intertwined with broader economic dynamics, where factors like tariff deadlines, inflation, and geopolitical risks are forcing investors to remain vigilant. And as always, it's the resilience and flexibility of our investment strategies that will ultimately dictate our success.
And I want to take a moment to give a big shout out to PantheonAI, your information copilot that helps you navigate these intricate market landscapes with confidence and insight. It's not just about following the numbers, but about understanding the stories behind them, and that's exactly what we aim to do every single morning.
Well said, Sarah. Now, as we close today's briefing, I'd like to leave you with a few final thoughts and questions to mull over. How are you positioning your portfolio in light of these ongoing geopolitical tensions? What strategies are you employing to hedge against potential shocks in the energy sector? And lastly, if you were to advise a friend about managing risk during such uncertain times, what wisdom would you impart based on today's insights? We invite you to think about these questions and share your thoughts with our AI copilot. We're here to help answer your questions and provide further clarity on these evolving trends.
And remember, tomorrow's episode promises to bring even more insights, more analysis, and yes, even more numbers that will break down together in a relaxed, conversational manner. So come back tomorrow and keep those questions coming. In this ever-changing market landscape, teamwork and a bit of humor makes navigating the complexities so much more enjoyable.
And with that, my friends, thank you for tuning in to today's briefing. Stay sharp, remain curious, and make those thoughtful decisions. As always, learning shouldn't feel like a full-time job. Have a great day, everyone, and I look forward to catching you on our next episode.
PantheonAI, your information co-pilot.
because learning shouldn't feel like a full-time job. Take care and see you next time.